Welcome back, everybody. With the promise of high dividend yields, covered call ETFs are all the rage in 2023. We just talked about JEPI last week, and today we're talking about the YieldMax ETFs, specifically the Tesla Derivative Income ETF, TSLY. Now, the YieldMax ETFs don't have any actual affiliation with Tesla or the other companies they have ETFs for, like NVIDIA, Apple, or the ARK Innovation ETF, among others. But the growth of money flowing into these funds has been off the charts. And TSLY was created on November 22nd, 2022. And by the end of January 2023, they only had about $395,000 worth of assets. But by April 30th, they had $54 million in assets. And as of September 13th, they have $658 million in assets. Now that's just unbelievable growth. Now obviously it's not quite in the same league as something like JEPI with $29 billion in assets, but clearly there's something that's resonating with people to get that type of growth. So in this video, we're going to dive into TSLY, see what it's all about, and see who it might make sense for. So if we go to Seeking Alpha, we see that TSLY is currently trading at a price of $14.76. Now, it doesn't actually have a one-year return because TSLY hasn't been around for a year. But if we look at the max return, we can see that from a price perspective, it's down over 32%. Now, at first glance, that's a pretty jarring number, but remember, this is a high dividend yield covered call ETF, so we have to look at total return to get the full picture. And we'll get to the dividends in a minute, but if we just look at their year-to-date price action, it's actually up over 10%. Now, TSLY pays a dividend rate of $7.36 per share, which equals a whopping 50.19% dividend yield. So no wonder people are interested in it. I mean, that is just like an eye-popping number. Now, if we look at their dividend summary, it's so new that there's really no information here yet. But if we look at their dividend history, we see that TSLY pays a monthly dividend. And out of the first 9 distributions of the fund, the payouts have ranged from 44 cents all the way up to $1.07 per share. So that's quite a bit of variability that's possible from month to month. Now, if we look at TSLY's current holdings, there's a lot to look at here, and most of it is probably a little confusing, with government being the primary holding in over 100%. But don't worry, we're going to dive into their strategy and their holdings and why it looks like that all here in a minute. Just real quick, if we look at expenses, TSLY is obviously actively managed, so they're going to be charging a higher expense ratio than a traditional index fund, which we see it here, it's at 0.99%, which effectively is $99 for every $10,000 invested. All right, so now let's dive into TSLY's objectives and methodology and see if we can figure out what it's all about. As you can see front and center on their website, it says, the YieldMax Tesla Option Income Strategy ETF is an actively managed fund that seeks to generate monthly income by selling call options on Tesla. TSLY pursues a strategy that aims to harvest compelling yields while retaining capped participation in the price gains of Tesla. And if you remember from my JEPI video last week, it's kind of a similar idea where we want to generate income through selling options and still have a little bit of price appreciation. But in this case, it's about Tesla as opposed to the S&P 500 index. And then if we look at the investment objective, it says the fund's primary investment objective is to seek current income. The fund's secondary investment objective is to seek exposure to the share price of common stock of Tesla, subject to a limit on potential investment gains. So right off the bat, they're making it clear this fund is about generating income, not necessarily long-term growth. And they talk about that even if they do get exposure to those gains by Tesla, it's going to be capped, obviously because they're selling covered calls. And then there's some important additional pieces of information in small print on the page as well. And there's just 2 points that I wanted to call out from that. Now, one, it says that the fund does not invest directly in Tesla. And you might be wondering, well, how did they sell covered calls if they don't actually have shares of Tesla? And we're going to go through that next. But real quick, in case you didn't know, they say investing in the fund involves a high degree of risk. Investing in the fund involves a high degree of risk. The point is so important that they had to mention it twice. Now, I have to say, the documents around the YieldMax ETFs I thought were at least pretty good, to where they lay out everything in a fairly consumable way, including how they use option contracts to mimic the price action of holding Tesla shares without actually holding any Tesla shares. And the way they do that is with a synthetic covered call strategy. Now, if you're like, wait a minute, synthetic covered calls sounds very eerily like...
We call them synthetic CDOs.
What did you... Synthetic CDOs. Short everything that guy has touched. I want $500 million more swaps.
Now, it's not quite as dramatic as a synthetic CDO in The Big Short, but they do share some similar properties. A synthetic covered call is meant to mimic the same payoff characteristics as a traditional covered call, but without actually buying the stock. So how could it do that? Instead, you initiate two other option positions to mimic the same effect. One, you buy a call option on Tesla at a price that's close to the current price. Then two, at the same time, you sell a put option on Tesla at that same price. And if you're confused as to what it means to sell a put option, let's break that down. When you sell a put option, you are giving a buyer the option to sell a stock to you at a certain price by a certain date, and they give you a premium to have that option to sell. Now, if the stock price stays above your option price, the option expires worthless and you get to keep the premium. If the stock price dips below your option price, the option gets exercised since it's made a profit, and while you keep the premium, you also have to buy the shares at the price from the person who holds your option. Or you could choose to close out your put option, which would mean you would effectively take the loss as if you would have bought the shares at the higher price. So if you think about what happens when you just buy Tesla stock, if the price goes up, you get a gain. If the price goes down, you get a loss. And this option strategy mimics that same thing, but it does so with more leverage, which means that the potential for gains and losses are both higher. And hopefully you're not too confused yet, because there's one more piece of this option strategy, so just bear with me. Once you mimic holding the Tesla shares with your two options positions, now you have to actually sell a call on Tesla at a price that's 5 to 15% higher to try to generate your income for the fund. So the 10-second recap is they do 3 different options positions to do a synthetic covered call on Tesla. 1, they buy a call option at the current price with an expiration date of 6 to 12 months out. 2, they sell a put option at the current price with an expiration date of 12 to 6 months out. And then 3, they sell a call option at a price 5 to 15% higher than the current price with an expiration date of 1 month or less. And then basically what they do is they take their gains and losses for each month, that becomes a distribution to shareholders, and then they sell more call options for the next month to do it again. And then every 6 to 12 months, they reset those first 2 positions and rinse and repeat. Simple, right? And then one last part of their strategy is that they actually hold most of the net assets of the fund in short-term U.S. Treasury securities, which they basically use as collateral. And if we look at their holdings on their website, you can see this. There's the call option that they purchased, the put option that they sold, and the call options that they sold, along with the majority of the funds in treasuries. And one benefit of using options with this strategy instead of just buying the shares is that it allows you to get effectively the same result with using less cash. And they can basically bank the cash that they have as collateral, putting in short-term treasuries to earn a little bit of yield. Now, obviously, the option strategy comes with its own risks and additional leverage, but in general, that's the idea. And like we talked about in the JEPI video, option premiums are impacted by how much volatility is in the market, or in this case, how much volatility there is for Tesla stock specifically. And historically, there's been a lot. But dividends can also come from the yield on treasuries that they hold and from return of capital. And they spell that out in the prospectus where it says, there's no assurance that the fund will make a distribution in any given month. If the fund does make distributions, the amounts of such distributions will likely vary greatly from one distribution to the next. Additionally, the monthly distributions, if any, may consist of returns of capital, which would decrease the fund's NAV and trading price over time. As a result, an investor may suffer significant losses to their investment. So obviously at first glance, this is pretty scary language, but I think the reason why they put that in there is they're basically saying, look, income from selling options is not guaranteed. It may vary a lot from month to month, and you may not get a distribution. And I think the idea there is that if they had a bad month selling options and they weren't going to be able to provide a dividend, then they can decide to return some capital back to shareholders so that they keep the dividend going and then try again the next month. Now, is that a great thing? No, probably not. But I think this is just there to give them the option in case it made sense. All right, so let's talk about taxes. And for the most part, we just don't know. And let me tell you what I mean. Now, in the prospectus, it says fund distributions are generally taxable as ordinary income, qualified dividend income, or capital gains, or a combination. So it can be anything. That's not really helpful, but I think what's likely to happen is because the dividends are going to mostly be made up of option premiums, it'll probably be taxed as ordinary income. And continuing on the theme of not knowing very much, portfolio turnover is also something that we don't really have any insight in yet. And they talk about it in the prospectus, but they don't really tell us much. Basically just saying, because the fund is newly organized, portfolio turnover information is not yet available. All right, so that is a lot of information, and hopefully it made a little bit of sense to you so you have a better idea of what TSLA is doing and what they're all about. And it's good timing because we just talked about JEPI last week, and there are some similar properties. So being able to look at how they compare, I think, is helpful. Now, how JEPI is made up is it's 80% invested in low volatility, good risk reward stocks that are in the S&P 500. And then it takes 20% of its assets and uses covered call options on the S&P 500 index to generate income. In terms of dividend yield, it pays, I think, roughly 10% right now. The fund manager in the past has said to expect maybe closer to 6 to 8% every year. And then if we look at TSLA, the fund's assets are about 90% invested in U.S. Treasuries, and then a net 10% in options. And I say net because whenever you sell options, it actually shows up as a liability, like as a negative, and then the ones that they buy are a positive, but ultimately they net out to equal 10% of the fund. Now, when I look at these, the main differences that I see is that JEPI is trying to get some upside appreciation from the 80% of the low volatility stocks that it's holding, and then using the other 20% to try to generate the income with S&P 500 index as their covered call security, which is obviously going to be less risky and less volatile than just using TSLA by itself. In Tesla's case, it's not actually invested in stocks at all. It has the bulk of its money in treasuries as collateral and is trying to generate all of its income from Tesla options, and assuming that over time, Tesla's stock price is going to go up and not down. Because if Tesla's price goes down, obviously Tesla is exposed to that. And just to show you how volatile Tesla can be, if we just look at the price action from July 18th to August 18th, we see that Tesla lost 26% of its price. And then if you look at Tesla during that same time, it actually only lost 22% in total return because you got the dividend. And you might say, hey, it was even better than Tesla. Look at that. And you're right, it was. But whenever Tesla goes up, it tends to go up a lot. And Tesla, by design, is only going to go up a little because they're selling covered calls, and that limits the upside. All right, I think we have a pretty good idea of how it works, how it compares to JEPI. Let's talk about some risks. And Tesla is going to have a lot of the same additional risks that JEPI had. And if you remember, those were, 1, it's actively managed. So you're dependent on YieldMax to make good decisions every single month for as long as you hold it. That's a management risk. And that risk, again, is slightly higher because we only have 9 or 10 months of history with these. And then 2, the dividends of the fund are dependent on volatility, and in this case, specifically around Tesla stock. And then 3, the covered call strategy presents a return risk because they're capping the upside potential by design. And when it comes to Tesla and how it trades, that can actually be by a lot. And then 4, even though you're capping the upside, you're still exposed to all the downside if Tesla goes down by a lot. And with Tesla, you're actually exposed to a few additional risks that you aren't with JEPI. So 1, it's dependent on one stock. I mean, Tesla is obviously completely dependent on the price movements of Tesla and using leverage to see their returns. Then 2, Tesla has additional options market risk since they're 100% dependent on options in their strategy, and specifically Tesla options. There's risk of availability in the market as well as liquidity, which impacts prices and spreads. Now, Tesla has a large options market, but I do think it's important to call this out. And then lastly, we just don't really know a lot about these YieldMax ETFs because they're so new. We have no idea if they're going to be able to sustain a 50% dividend yield. We're not really sure how the taxes are going to work yet, and we're probably not really even sure how effective they are at trading options because they're so new, there's so many question marks around these ETFs. All right, so who exactly is TSLA for? In my opinion, TSLA is for people who are willing to take on a very high-risk income play. Now let me explain what I mean. On my JEPI video, someone commented that people should look at JEPI like buying into a small business that generates cash flow for you. It's not going to be some huge growth investment, but it can give you steady income for doing nothing, and you can use that income for other things. Because with TSLA, I actually think this analogy of investing in a small business that gives you cash flows makes even more sense, as long as you attach the appropriate risk to it. Because to be clear, TSLA is a speculative income investment. It's not like a traditional buy and hold, I'm going to buy this great company, and it's going to do well over time, and then I'm going to get rewarded as an investor. That's not what this is. It's more like if you invested in your friend's new small business and it was really risky, you don't know if it's actually going to last, but they're able to generate some cash flow at least for the last 9 months that they've been doing it, and they're willing to give you 50% a year to get that capital. So for anyone who's actually willing and able to take that risk, how you should probably approach it is, 1, only invest money that you're willing to mostly or completely lose. And then 2, look to get your capital back as soon as possible from the dividends. And what I mean by this is, if I was going to open a position in TSLY, and let's say I put $1,000 into it, every month that I get my dividends, I'm going to just stack that up until I get my $1,000 back. But then once I get my money back, or at least most of it back, then I've created this income stream of any new dividends that I get are virtually risk-free, except for the opportunity cost of being able to invest it into something else. To me, that's the most interesting scenario with TSLY. Now, obviously, you could also hold it in a tax advantage account if you wanted so that you wouldn't pay tax on those dividends. But, if you're in retirement, I personally just think it's too risky to hold in a retirement portfolio where you actually need and depend on the money. In that case, I think JEPI is a much more conservative option to achieve a similar goal. But if you're a long-term investor that's trying to put it into a retirement account to avoid the taxes and get the income, it just doesn't make a lot of sense to me, because TSLY's only going to do well if Tesla does well. And if Tesla does well, you might as well just buy Tesla, because it's going to outperform TSLY if it's rising by a lot. But using it to build an income stream could work, even though it has a lot of risk, a lot of volatility, and a lot of potential for loss, because it has such a high dividend yield. So the time that it would take to recoup your investment is shorter than, let's say, a fund that pays you 10%. But it is extremely risky, so it's definitely not for everyone. And in reality, it's something that most investors shouldn't even be looking at. But for those who have the money to lose and want to take a chance at building up an income stream for additional cash, it could be an option if you can stomach the risk and have a disciplined plan to recoup your investment as you go. But that's just what I think about it. So when it comes to TSLY and the YieldMax ETFs, are you guys interested? Are they too risky for your portfolio? Let me know down in the comments below. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you guys in the next one. Peace.